Sanjay, what do you make of the yields on 10-year bond coming down and SBI's one-year rate not really changing much? It's probably the highest differential since the end of 2008. Do you believe that something needs to change over there? Either RBI has to signal a rate cut or probably further measures so that rates in the system come down?
So I would say that we saw the yields come down on the 10-year GSEC in the anticipation that the RBI would cut rate in the policy that just went by. But that has not happened. And after that we saw some amount of yields hardening. But at the end of the day, the decision by RBI not to cut rates probably is just, I would say, dictated by the complexity of the situation that we are passing in today. And this situation will clear out hopefully by the end of this month. One thing is a foregone conclusion that there will be a fair amount of liquidity which will be in the system, in the banking system, through bank deposits and so on and so forth. And therefore, the overall inflation trajectory, if we don't expect the crude prices to go up, is also likely to go down. We've seen that the retail CPI that came out just a couple of days back is, after a long period of time, fallen below 4%. So all of these things are actually pointing to a situation where the inflation trajectory, rather than going up, is quite likely to be level at the current point, at the current levels, or it is in all likelihood going to move a little down. So if that be the inflation trajectory, I think fair ground has been set for the RBI to cut rates. Now that we have the Monetary Policy Committee as a focal decision-making body or the advisory body on the basis of which the rate cut decisions will be taken, I anticipate that this rate cut will happen in the next policy and may not happen between now and the next policy. But the GSEC yields can surely move in anticipation of this rate cut to be announced in the next policy.
Right. In terms of Nifty earnings, in the last few years, the earnings have been subdued and rates have been high. But this time around, after the rate reduction that we've seen in the last 1 year, I'm talking about the 10-year GSEC, the Nifty earnings outlook is strong and the rates are lower. Does it tell you that equity becomes a much more attractive class after the recent correction?
The classical interpretation would be yes. With the yields falling, of course, the earnings yield of the Nifty becomes more attractive and therefore the price earning multiples of the Nifty should be higher. But we also need to take cognizance of the fact that there has been a sharp reduction in demand in the period post the announcement of the demonetization. The industry numbers that came out at the end of November have probably not completely stated the decline in demand. We will see the cascading impact of that coming out in the numbers of December. If the demand destruction, as we have seen happening in December, if it continues for a couple of months more, then I don't think we can take a very positive view on the earnings, the Nifty earnings for the financial year 2017. But one thing is for sure, that I think whether demonetization is able to succeed in moving black money out of the system or not, it is surely going to move a large amount of business from the unorganized to the organized space. A lot of business activity that was not getting counted will hopefully now get counted. And therefore, there is a good case for the Nifty EPS for FY18 to be significantly higher. And if that is going to happen, I think the support to the re-rating of the market, which before 8th of November 2016 was coming from the fact that we were seeing an earnings growth in the markets, and therefore that would have justified the price earning ratio in India getting re-rated. I think now the situation is going to change. The view on the earnings upgrade may not be very short term in nature. The market might actually anticipate that the earnings upgrade and the earnings improvement will happen maybe after 6 months or 9 months. But in the background, that the yields on comparable securities and more particularly the government securities has come down. So earnings upswing in FY18 coupled with the fact that the yields on government securities has come down would be one of the primary reason why we can expect the market to go up, because we'll have two things happening together. The EPS of the market will be going up and the price earning ratio will also get re-rated.
Right. In terms of the recent correction, how would you look at the market? As of now, brokerages have not come out and reduced their earnings estimate. You belong in which camp? Should one look at FY18 earnings estimates, where the downgrades may be very, very limited, currency may be back to normal circulation, a lot of, unorganized business may come into the organized sector, as you said, GST would hopefully be implemented. So FY18 numbers you don't think would be cut meaningfully, which means markets are attractive?
Yes, I think that, at the present moment of time, we have actually not seen the markets decline very significantly. In fact, we've probably seen the Nifty levels come down by about, say, 3 to 4% post 8th of November. Now, I think primarily this is happening because there is fair amount of anticipation that while there is going to be pain in the short term, the medium term looks much better for the organized sector. See, the impact of demonetization, we'll have to look at it now divided into three parts. One, the impact of demonetization on the black economy, the impact of demonetization on the economy in the short to medium term, and the impact of the demonetization on the organized sector. I think as far as the impact of demonetization on the black money and the black economy is concerned, if we have by the end of December a significant amount of note that is going to be put into the banking system, and out of that, if a significant portion doesn't get declared in the IDS 2, then I think, in terms of the attempt of demonetization to address the issue of the black economy probably is not as successful as what we were expecting. But one thing is for sure, that this entire development has surely moved India from a very cash-oriented economy to a less cash-oriented economy. And that impact will surely be there on the organized sector. Much of the businesses will now get into the organized sector. Much of the disclosures will also happen. So therefore, the competitive pressures under which the organized sector was operating vis-a-vis the unorganized sector, those will also lessen. In terms of the impact on the GDP, from whatever is visible today, I think the impact on the GDP in the short to medium term is negative. But then, maybe some of the pain, like for example, there is a lot of pain as far as the daily wages sector is concerned. There is a lot of pain as far as the agricultural economy is concerned. From the stock market perspective, if you look at it in a very narrow perspective, that pain may not necessarily impact the EPS or the earnings outlook for the market. The markets may therefore look at more of an earnings improvement because of the impact of demonetization, maybe not in the short term, but in the medium to long term. And therefore, GST plus the impact of demonetization on the FY18 earnings might actually be more positive than what we anticipate. And so therefore, to sum up, I would say that I see pain in the short term, but I see much better days in the medium to long term.
Right. Sanjay, if you're expecting the cost of capital to go down and medium term you think that the markets and the strength of the economy is intact, then what are the sectors that you will look to buy? Will it be consumption? Because, consumption has benefited from financing to a large extent. Or will you look at something else, maybe infrastructure and maybe even capital goods, which could benefit from lower cost of capital? How would you pick what you would buy now on?
Okay. So, from this point onwards, if I have to take sectoral picks, one thing I think is surely going to happen. All the rate cuts that have been done by Reserve Bank of India, close to about 175 basis points over the last more than a year, we did not see the transmission of that rate cut happening in the lending rates. As far as kicker to demand is concerned, it is the lending rate that should have come down and not necessarily just the RBI rate cuts. The sheer amount of liquidity or the funds which have come to the banking sector, I think is going to exert some pressure on the deposit rates being brought down. And now that we are in an MCLR regime, I think since the marginal cost of the new funds is going to be much lower because of the lower deposit rates, I think the lending rates have to come down surely. Now, if you see the big ticket items of consumption, the ones which actually have a much more, I will say, a cascading impact on the economy, things such as vehicles, cars, motorcycles and real estate, these are very significantly influenced by the rates. And I would say that it is quite possible that the lending rates could come down by as high as 100 basis points from where they are today. And I think that would be a very, very significant contributor to the demand in these sectors. We also have a scenario that there is an anticipation that demonetization will bring down property prices, and that itself creates a favorable climate for demand for real estate also. So one of the significant sectors I think that one should look at prospectively should be the real estate sector and also autos. Coming to the other sectors which in my opinion become now more attractive, the infrastructure, the construction and the capital goods sector, I think I expect that we will see the government's finances being now much better, partly because of maybe the IDS2 disclosure, if nothing else, also because of the fact that with much more of the economy moving to a disclosed economy, a more organized and taxable economy, the government's coffers will also be richer. And today, when we have seen a shrinkage of demand in the private sector, I think there is an imminent need for the government to come on the front foot and increase spending and get that spending to happen very fast. So this will be one of the primary reasons which will benefit the infrastructure, the construction sectors immediately. The capital goods will also be, I will say, a collateral beneficiary of this. So the stance of the asset allocation within equity as an asset class will now move more towards these sectors, and one should not miss out on the most significant sector, which is the banking sector. I think that sector will be one of the primary beneficiaries of the scenario that is emerging in India.
All right. So you like banks and even the infrastructure plays. My question was vis-a-vis consumption. Would you prefer these more?
Vis-a-vis consumption, could you just repeat the
banks, infrastructure stocks more, because so far we've seen consumption stocks rally. So do you think now they will not rally as much as some of these names?
Yeah, so in terms of relative price performance, I expect that these sectors which I mentioned, banking, auto, construction, capital goods, these will appreciate more than the so-called fast-moving consumer goods sector.
So you've told us that these are the sectors you like. Do you think there will be some added thrust that these sectors will get from the budget now? Because we've got these triggers out of our way, whether it was the RBI or the Fed move. What do you expect out of the budget, and what sectors do you think will get a big thrust from the budget?
Okay, so yes, I think that this range of the market where we are stuck in today, which is between 7,900 points of Nifty to about 8,500 points, this range has to be broken by some policy initiative. I would have been very fearful if the downside level of the market, which is 7,900 points, getting broken. That would have happened probably only if there was a global financial crisis, or there was a large amount of depreciation in the global asset classes, particularly say equity. But we have seen that post-Trump the Dow has rallied. It has led to some amount of reallocation from the emerging markets to the developed markets, but I think that is not so significant. If we don't have any of these sort of crises happening anywhere, we've seen the Italian referendum come and go, then I think the downside support to the market is fairly intact. The upside level of the market, which is 8,500 points of Nifty, if that has to be broken, that can only be broken if we get out from this, the period of uncertainty. Today, the assessment of the impact of demonetization has not fully been factored. We also do not know how much of the money is not going to be converted. These uncertainties will probably get resolved within probably the next one fortnight, or at maximum probably a month. The next big thing that the market is looking forward to is the budget. And in the budget, if there are significant propositions, and I hope that, unlike the RBI policy, the budget does not disappoint. It has at least, it meets two significant expectations. One is that there should be some tax relief that should be coming in the budget, both for individuals and corporates. That will be received very positively by the market, and I think that would break the upper cap that we have seen the range setting at about 8,500 points. The other thing that I expect the budget to be doing, and I know this budget will be combining the railway budget and the union budget. So the amount of spending that the government is willing to do on improving the infrastructure is the second big thing that I am looking at, and the multiplier effect of this is something that can magnify the positive momentum that the economy can get post the demand destruction that we have seen in the last couple of weeks. And the third and equally important factor that I need to mention is that there is a need for some government initiative to get the demand back on track. We've seen some amount of this happening in the last budget proposition, where a lot of importance was given to the rural economy, both by directing infrastructure spending in the rural sector, also sparking a lot of relief to the rural sector. I think that rural economy is today one of the victims of the recent developments, and I think there is certain amount of relief if it is given, which can kickstart demand in that area. That would be the third expectation from the budget.
Right. In terms of what's happening with the consumption side, what's happening with some of these names like Havells, Asian Paints, where currently you're seeing raw material prices also go up. And on the other hand, because of demonetization, November, December is expected to be on the weaker side. But some of these brands, some of these franchise that are available, do you think they are great franchise to own, say, if the correction were to slightly deepen from here on after Q3, Q4 numbers?
So, my answer to that is based on two assumptions. One assumption is that, yes, crude prices have gone up. But I think, we probably have seen probably the best of the appreciation of crude prices. I do not expect crude prices to go up significantly from the current levels. So that is my assumption number one. Assumption number two is that, this destruction in demand that we have seen, I think it is more psychological in nature and not necessarily fundamental in nature. This sort of psychological inertia that has come, and that is the one which is today inhibiting demand, I think this will go away reasonably quickly. So if that is to happen, I think we will probably see the demand and the offtake levels of the products of these entities that you mentioned coming back on track. In which case, if they were commanding premium valuations then, they will again go back to commanding premium valuations once again. And mind you, they were commanding premium valuations when the market valuations were not so high. My proposition and the primary proposition is that, with the earnings of the markets likely to be upgraded for FY18 and the price earning multiples of the market getting re-rated, there is also a stronger case that, the discounting that these companies will be having, the ones which have a premium by way of their brand equity, by way of the way they have been able to penetrate the market, that also in relative terms compared to whatever be the price earning multiples they were trading, say about 6 months back, would also be higher.
Right. I know you cannot talk about stocks, but just taking an example of Asian Paints, you may not give your view in terms of you would want to buy or sell, but just looking at the example of Asian Paints, it's been a great wealth creator. It's a very strong brand with a great market share. every time when crude prices have been volatile, when demand has been low, when competition has been higher, they have still not cut prices. In fact, they have been able to always, give good margins. I checked when crude prices went high, their EBITDA fell by 50% in 2009, one of the quarters of 2009. But post that, there was a very strong recovery because they passed on the price hike. The demand did not get destructed that much. You think strong brands with pricing power are the one that market should look at?
So, something that I responded to in my previous reply, that today there is a reduction in the volume offtake of these companies. In a background where there is very little demand, the ability of the manufacturer to increase prices because of the prices of the raw materials going up is going to be very, very limited. The first thing that needs to happen is that the demand has to come back on track. Once the demand comes back on track, they have every basis based on the fact that they have a brand equity, they have a very strong franchise to raise prices. But till the time that the demand comes back on track, raising prices will not restore their EBITDA margins.
Right. And in terms of valuations, consumer durable would continue to trade at a premium valuation. So don't expect the days of 10, 12, 11 times P when some of these stocks started to rally.
So I think, when I said that the destruction of demand is more psychological and less fundamental, when the demand starts coming back on track, it will not happen uniformly for all segments together. There will be some segments which will probably get precedence over the others. Like, for example, because of the elevated real estate prices, we did not see so much of a demand for even say middle class or a semi-premium real estate. But that was happening because of two reasons. One, because the price, on an absolute level, these real estates were priced very expensively, and secondly, because the borrowing rates were also reasonably high. Two things, if they happen together. One is that in absolute terms, the real estate prices come down, and the lending rates also come down substantially. The first level of demand that will kick in will be for the real estate. The second level of demand that will come in, and that will probably also come in from the secondary buyers, would be the demand for durables and other such goods. So we will see demand getting restored in the Indian economy. The only proposition that I have is that that will be staggered and will not be uniformly across all segments together.
Right, Sanjay. Thank you so much for taking out time for us. Always a pleasure.